Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, June 29th, 2016. In this video, I wanted to do an overview of the leading index, the QQQ, NASDAQ 100, tracking ETF that is. And as I like to do, I wanted to go through some of the top components. As I often state, unlike some other indices out there, indexes that are more balanced, the QQQ is very top heavy, with the top 10 components alone making up over half of the entire returns of the NASDAQ 100. So as I often say, if you want to know where the market's going, you look at the leading index, which is the NASDAQ 100. And if you want to know where the NASDAQ 100 is going, you simply have to know where the top components are going. You get that right, you know where the market's going. So, all right, let's dive into it. Let's start. We'll work our way up from the bottom here. Let's go down to what's happened in this long-term chart. This is a 10-year weekly chart. Here's your the time frame down here, going all the way back to 2007, or actually should be 2006 at the end of the chart. Yep, just cuts off 2006. And you can see this is the primary uptrend line. There's a lot of lines here. Forget about all the white trend lines for now. This was our primary uptrend line. Although the Qs, they did technically bottom back in late '08, just a hair lower. All the other major indices bottomed back in March of '09, and that's when that's where I decided to use the trend line to really, it just fits well. And I think this is the most significant trend line. So the yellow trend line is what I call the primary bull market uptrend line. You can zoom in, see it captured some reactions here. And then most importantly, we had a very impulsive breakdown. Once prices broke below that level, you can see a very impulsive weekly candlestick, a second even more impulsive weekly candlestick. That went a little bit farther than the actual index. There was a mini crash in the Qs due to order imbalances at the open that day. So obviously some orders were filled away from the market. Again, called a mini flash crash. But we still had a pretty big down candle in the NDX as well, the actual index that the Qs are tracking. So my point being that the impulsive nature of the breakdown helps to validate that primary uptrend line. And after that, we had a perfect back test of the trend line, and prices have rolled over since. So bigger picture, this was our bull market in the Qs. This was the bull market breakdown, the primary uptrend line break. Yes, we put in a higher high there. Not uncommon to see on any trend line break a back test come and then a successful back test, meaning we back test the trend line, roll back over. And so far as this trend line here shows you, we've been in a downtrend making lower highs since. I have this secondary uptrend line, I call it, and this one has numerous reactions. This white line right here, we'll make it a different color so it'll stand out. Let's do, this color stands out well, this purple color here. You have numerous reactions on that secondary uptrend line. You have a breakdown there, also impulsive. You can see the impulsive selling following that breakdown. Perfect back test. So this is TA 101 at its finest, and we have two primary and a secondary uptrend line break. Prices back testing both and rolling back over and in a downtrend. As I mentioned, the negative divergence was leading up. We had divergence leading up to the highs, multi-month, actually multi-year divergence. And down here on the trend indicators, I've mentioned many times, this PPO is my preferred choice on a weekly chart over the MACD. It is very similar in nature to the MACD, uses slightly different calculations, does a better job on any securities with a very large range in price. By range, I'm talking, here's, the Qs on this scale, looking back on a 10-year weekly chart, were as low as around $25 and as high as about 100 and something. So in that case, a MACD will look a lot more flattened out. To keep this video short, I won't go there. I could throw one up and show you the comparison, but I want to try to keep this video short today, relatively short. All right, so the how I use this, other than to identify the divergences, just as with a MACD, is as a trend indicator. You look at the 9 EMA, which is a signal line on the PPO, just as it is on the common settings for a MACD, and that's the white line. So when the white line crosses below the zero line, this dotted line in the middle, the trend is bearish. We had a sell signal there. perfect. Came in back tested. That was, by the way, that sell signal came in, very early 2008. Told you we were in a new bear market, primary downtrend, kept you short, or just verified the trend was bearish until not too far. We had an explosive move off the lows in 2009. And as I often say, this nor any one trend indicator, in my opinion, should be used as a buy alone, a standalone buy and sell indicator. It's simply confirmation of the trend, and we're talking a big long-term trend here, and the accuracy on this is nothing short of amazing. You can see once it crossed above that level, it signaled that the primary trend was up all the way until recently. Now, if you want to get very technical, you can zoom in here and you'll see that white line crossed back here in 2011. I've talked about this before. That drop in 2011 was technically a bear market in several of the U.S. indices, small caps, mid caps. I think the NASDAQ composite exceeded the standard definition of a bear market with a 20% drop. The Qs, if I'm not mistaken, fell just a couple percentage points shy, or maybe not even a full percentage point shy. My point being, I don't call that a whipsaw signal. Take it for what you want, but that was a pretty rough time, and at the very least, it might have given someone a heads up when they saw that crossover to, okay, step aside from your long-term, long side positions. And once we had a cross back above, and it started moving comfortably away from that zero line, then they told you it was safe to get back into the water. You can see here, it also, like any good trend indicator or anything in technical analysis, at zero level, which is the defining level, also works as support or resistance when tested from above or below. So you see here, we had a near sell signal back in October 2015, but it didn't trigger. Bounced off, stayed above, and then crossed over. And at this point, since early February, it has told us that the primary trend, for the first time, going back, and this was a pretty good signal, and we've been below it for a while, so I don't consider this a whipsaw. So for the first time, and it looks a lot like this. If you take a look at 2008, when it went over, it crossed down, came back up, and I remember I was trading back here. Everybody thought, oh, wow, that was close. Looked like this market was really going to go down. This was a euphoric rally. And I mean, just look at the price action. First leg down, push back up. See this trend line? Another leg down, push back up. Well, that's what we have here so far. If you zoomed in and overlaid these, they look almost identical. This trend indicator is doing the same thing. It broke down. It's remained above. I mean, you don't want to split hairs. If you can look here close enough, it might be a hair below that zero line, but not close enough. Since it's traded below for months now, you want to see it definitively crossing up and moving back up and away from this to say, okay, now that trend indicator is bullish again. All right, I didn't want to spend too much time on that, but I do think it's important because, again, we triggered, this has moved far enough below the zero line and remained below the zero line far enough, indicating that we are in a, by this metric and other things that I use, in a new primary downtrend line. It's primary downtrend, excuse me. It's as simple as that. Until proven otherwise, let's see if maybe it's a big whipsaw signal. If nothing else, it's been one heck of a correction off the highs. So, that you can't really fault that indicator if market happens to push back up. All right, we're on the daily time frame now. I won't spend too much time here. This is the Qs. We have nice resistance here at 105.90. That's a level I've talked on for quite some time now. That 105.90 seems to keep popping up over the past few months. We'll make it even brighter so you can see it there, 105.90. And if they happen to take out 105.90, 106.50 looks like a very solid level. 106.50 is the top of this candlestick here, the candlestick shadow or the wick right here. You've got the bottom of this candlestick body and the bottom of this candlestick tail or shadow as well. So there's quite a few points, and you can go back in time and there's other levels there. All right, so that's what we're looking at on the Qs. My expectation is for a failure and a resumption of the downtrend. MACD is below zero. The zero line, that's also, works as a trend indicator there as well. And let's look at the 60-minute chart. I think this tells us a little bit more here. All right, here's the 60-minute chart. This I'll draw out for those of you that watched the video yesterday, or I even put this up in static post. A couple things. Going back to Monday, yeah, I posted that we had some of the markets, I should say, the majority of the U.S. markets were at support, at or near support levels where, a bounce was likely. Keep in mind, we had a very sharp sell-off since, going where the highs were a couple weeks back. And this is nothing so far, in my opinion, my read on the charts, nothing but an oversold bounce, and it was unexpected. That's why I lightened up some short exposure, started adding back yesterday at the bottom of this range. We gapped above it, so as my plan was, if you watched the video yesterday, I'm not adding it yet. I will add if we come back down. My expectation is that we fail, that this breakout fails. So if and when we move back below 105.20, as well as the levels that I'm about to talk about oh no, I won't get to the SPY in this. I already covered those in static posts. We're going to stick with the Qs today to keep this short. That's my plan. So let's take a look here. Draw an arrow. This is what I think will happen today. Now, if we continue to move higher, this is resistance, 106.30. It's a pretty significant level. 107.20 after that. You can see the top of that gap there. These are all key levels. So something else to note here that I find, I should say, it never fails to amaze me how well Fibonacci retracement levels work. This line here, this yellow line, is just a Fibonacci retracement from the recent highs back here a couple weeks ago. Let me try to move my crosshairs. We hit a high back around June 6, and here's the lows on Monday. And now keep in mind, the horizontal lines that I have here, these levels I added before I even put the fibs up. I just put these fibs up today. And you can see almost perfectly how the key Fibonacci retracement levels, the 38.2, the 50%, and the 61.8 come in with my my resistance levels, the key resistance levels that I'm watching. Fibonacci's, not just in trading. If you really read up on the Fibonacci sequence, Fibonacci ratios, and how often they show up in the natural world, astronomy, you name it, it's just incredible. So there they are. Either way, whether you're a fib trader, support and resistance trader, I incorporate both. Those levels are pretty solid levels because, again, there are certain subset of traders that only trade off fibs, and so they're watching the same levels I'm watching. When I see fibs line up this well with horizontal levels, I can't tell you which ones will hold, which ones will reverse the market, but I can tell you get reactions. I mean, look, this isn't coincidence. We closed right at that resistance level there, the 104.48, gapped up to just right on that 105.20. We've moved up now. So if we push any higher, I would at the very least expect a reaction here at 106.30. Reaction defined as a pullback and or consolidation. I already stated what I think will happen, but until it does, as I mentioned yesterday, my trading plan right now, we're in no man's land. I'll just hold off, wait and see what happens. If we continue to move higher, if we take out 106.30, then I'll start to become concerned. Where do I start scaling out or putting stops in my shorts to protect profits or minimize losses if I decide to give it some room? But right now, just watching. Let's see how the day finishes here. If we end up within this range between 106.30 and 105.20, we'll just have to, this movie will have to be continued tomorrow or the next day until the market shows us the next direction it wants to take. All right. What didn't I cover here? Let's see. I mentioned that the trend indicators are still bearish. This 1333 histogram, which has done a good job of defining the near-term trends on the 60-minute chart. Just as that PPO on the weekly chart does a good job of defining trends, when the 9 EMA on the MACD, which is the white line, is above or below the zero line, it also defines trends. And you can see here we had a crossover right here around this point, back tested the zero level and fell back down. So the trend, for the most part, I should extend all these lines here. Just clean this up. The trend, barring that very brief whipsaw signal, has been bearish on the 60-minute chart and remains clearly bearish right now, and that goes all the way back to here. So this is how these trend indicators work. And you know, the tough part is, are they going to flip to bullish? And if they do, by the time they do, how much give back will you have? Well, I already shared my thoughts. Yeah, it's possible, but I don't think we're going to get up. I don't think we're going to get up to these levels. All right, let's take a look at the individual components. This video is running a little bit longer than I wanted to make it, so we'll go there, take a look at some of the top holdings, and I'll wrap it up. I'll start again on the weekly time frames on each of these and run through real quick. This is Apple. Everybody follows Apple. Apple's the the big dog in the NASDAQ 100. It's lost its in the last couple of years with the drop that it's had. It was the world's largest company. Today, I don't know if it's still number 2, 1 where it's at right now. But either way, a very important stock, both technically because of the weighting in the NASDAQ 100 and from a sentiment point of view. You know, if Apple breaks, the king is dead. And in my opinion, Apple did break. I know it was April 28th of 2015 last year where Apple topped. Yeah, put it on, pointed that out at the time, mentioned it was, high was on an earnings date, April 28th. I'll never forget that day. Put in a very bearish stick, and that was the top. And Apple's been in a bear market since, well exceeded the 28%. Back here, it had dropped 32% at that point. So you can see it working its way down a downtrend. This 40-week moving average, which is the same as a 200-day moving average, I've pointed out many times in the past, has just done a phenomenal job of defining bull and bear markets in Apple, primary bull and bear markets. When prices are above that 40-week moving average, you're in a bull market or an uptrend. When they're below, as back here, we had a 45% drop from the highs. And you can go back here. Again, I've gone over this many times, so I shouldn't spend too much time on it right now. And I also mentioned there are occasional couple weeks where you might get a candlestick or two closing above it, or an inter-week pierce. But so far, this 40-week has been containing this downtrend, and we're well below it right now. There's a little, I'm not short Apple. I don't like the fact there's bullish divergence, but the trend is still lower. So, while I am short the Qs, and I'm short some individual components, I don't have an interest right now to be short Apple. I just don't see as big a drop in it as some other ones. But the trend indicators are bearish. I have here, I put a red line just below the 0 level because that 9 EMA on the PPO works well there as well. But I noticed that if you put this line at the negative 2.12 level, that tends to do a better job at defining the trends in Apple. And you can see there the PPO is still on clearly into bearish territory, saying the primary trend in Apple is down. So that's the world's, one of the world's largest companies. This is that 92.50 level. That was a big critical support level. You can go back on this daily chart and see this had a breakdown, which was a death knell for Apple until the white knight Warren Buffett came riding in and said, "Oh, Berkshire loves the stock. We just took a big stake." And there's the Buffett rally, almost all of which was faded so far, and we're dancing around that 92.50 level. There's a gap right there in Apple. You can see right here resistance around 94.75, and Apple has yet to take that out. If it takes that out, that would be the first bullish sign, but it still has a lot of work to do. And again, the primary trend is down. MACD is trading below the 0 line there. 60-minute chart. This one I've pointed out quite a bit in the trading room lately. You can see we're in a clear downtrend. That's on the 60-minute time frame. There's your downtrend line. This was a rising ascending price channel. We broke down, pointed that out. We had this little minor uptrend channel here, and prices have been trending lower since. And first bullish technical event would be, well, let me just point one thing out and then I'll get to the price. We had a bearish cross on 1333 histogram there. A little bit of a whipsaw signal, but the trend has remained bearish since, as has the MACD being below the 0 line right there. Okay, price-wise, I can draw a horizontal level here. I think I just pointed that out on the daily chart. Let's put it around. I'd have to put a zone here if you're trading Apple. Quite a bit of resistance. So let's just say it has to clear any of all of these lines. But the first bullish event would be to take out this downtrend line. So again, I do these videos. I might be bearish, but there's going to be many times I'm wrong. So I've been wrong before, I'll be wrong in the future. If you're bullish and you want to go long Apple, this is what I would look for: a break of that downtrend line, a break of any or all of these lines here, and ultimately I should put this would be the most important level. If and when it takes that out, that would be very bullish. I don't expect it to happen, but look for a green line. That green line is at 132, and it's got some work to do to get there. I'm more apt to, and again, I don't have a desire to short Apple right now, but if I did, it would be right here, right now, because I'd expect a failure at this line. You could wait for a full test of that line, but again, I wouldn't short it here. If I were to short it, I would wait for a break of those recent lows right there. So these are the most important levels on Apple to kind of wrap this up. The recent lows, this downtrend line in the intermediate term, but then you're banded up here by that 130. That's a big important level in my opinion on Apple. Okay, spent probably too much time on Apple, but it is an important stock again. Let's look at Google. Or Alphabet now. I don't know why they preferred the name Google, but anyways, this is a bull market uptrend line, pretty clear one. A lot of numerous reactions there, well defined. We're dancing on it right now. If it didn't have this negative divergence in place like it does here on the weekly time frame, I might say, well, this is a great time to go long. You want to buy a stock on support, pull back to a trend line, as you did here, 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 here. But ultimately, trend lines break, and you're looking at a bull market that, as we know, well, we may be in a new bear market, but let's just assume for the sake that until all the major indices have dropped 20% or more, we're still in a bull market. And then this has been one of the longest running bull markets in history, both in time and in scope, or percentage gains, that is. So there's Google or Apple, Alphabet. Looks like a matter of time before this trend line breaks, in my opinion. There was a minor uptrend line which broke, and there's your targets. All these lines are targets, and before all is said and done, the very least, I would have to say right now at this point in time, and that can all change. That would be my primary target right there. If I were to be short Alphabet, I'd cover right there at that level. Daily chart. I pointed out this potential. I told you I wasn't crazy about it. This potential head and shoulders topping pattern with this being a head here, left shoulder, a head right there, right shoulder, and I had two alternative necklines, that yellow line or this purple line. Symmetry is not great. Shoulders came pretty close to that head, but something to watch. So the trigger would be a break of the down-sloping neckline here. You had a divergent high up there at whether you want to call it the head or the peak in Alphabet. So either way, that one, again, indicates that longer-term trend line that we just looked at may be broken over time. Pretty key level right there. 703, you can see look at the volume at price histogram. See all the bars back here, and it's very thin down here. We had quite a few reactions. This was a breakdown, and we're pushing up. So this kind of goes in my overall analysis on the market, right? And why I don't think the Qs are going to continue much higher, because we're looking now at these individual components, and we're looking at a lot of these coming up on resistance. So I might even tweak my plan that I wasn't going to add as I do this video. And this is one reason I like to do these videos. They help to clarify my thoughts as I do these videos and go through the stocks. And although I said I wouldn't add unless we fell back down into those add-on zones that I highlighted yesterday, I'm seeing so many key components, leading stocks, the top weighted components in the NASDAQ 100 that are coming up to very significant resistance levels. So that's Alphabet Class A, and here's the other share class here. This is the one I've been tracking more recently, and look at that 689 level. We kissed it. This was a level. Remember, I had this rising wedge I pointed out recently. We broke down, hit every one. All of my pullback or bounce areas, the support zones, except this one we sliced through. And it's just behaved so well off these levels. And that was a key level. The fact that we gapped down below it and had this impulsive move down, Then we gap down, back tested, failed, moved back up, and look, a near back test again today. So I mean, on a scale of 1 to 10, this has got to be a 9 or 10 for a shorting op. Even if I'm wrong, you short here, 689, and if it makes a solid break above, 60-minute close, daily close above, you cover, or you have all these levels. I would take this one out now because we traded through it so many times. So this would be your next key level. So I'll just give you an example. And this is just a trading example. Alphabet's not an official trade idea on the stock. So you short here at 689 because that's a key resistance level. Trend indicators are bearish, as you can see down here. The MACD below 0, 1333 histogram still in the sell. Excuse me, still in the sell signal. And you short there at shy of 689, and you cover there at what is that, 703. Move above that if you want. There's the next level up, but I would say that's pretty tight. Relatively tight stop. And bigger picture, if it breaks down below this level, it's headed a lot lower. There's the weekly chart. I have a slightly different trend line on this one, and I've excluded that temporary breakdown, and I did that because it captures a lot of the reactions here, and this one has us just breaking down. But as I often say, if I have a trend line and just below that, as I do here, a solid horizontal support, I wouldn't short the trend line break. You'd wait for this level to go. That's called 660. And then if it does, I just mentioned, relatively tight stop on that 60-minute time frame. I mean, this is huge potential for a swing short. Your minimum target would be this 591-ish level, and this is a very likely long-term swing target, 505. So with the stock trading at 683 today, you're talking, if you have the patience for it, there's a 20, 25, 26% swing short op. All right, Microsoft, we're on the weekly time frame. It's got a way to go. There's a support zone right here. We broke this minor uptrend line, support zone. This is your primary uptrend line, which would be the next target. And ultimately, if and when that goes, a very powerful sell signal. Microsoft looks better than most, but there's that support zone now. As I go down to a daily chart, I zoom in. We had a very powerful divergent high recently. We had this double top high, which was a divergent high. You can see down here on the RSI and MACD. To do my glass half empty, glass half full thing for the bulls, there is a divergent low. I'd be remiss not to point that out, although it's not confirmed. You see the MACD is still pointing lower. Tried to look like it was confirmed right here. That failed. MACD is pointing lower. I need to see the MACD curl back up and start moving back up to confirm that divergence. So again, one that, especially right now, I wouldn't short because you're right above this support zone. You've had two recent false breakdowns or intraday breaks, and prices managed to close right back up or below. And now, since we've had two of those reaction lows, this is the level to watch. This is just an FYI for those of you interested in shorting, or if you're long Microsoft. Let's say you've been long for a long time, you're a long-term investor. This is where I would have my stop on a daily close below 48.20, and this is a level if I wanted to put a long-term short on Microsoft, which I don't have any desire to do, but that's where I would do it under 48.20. We skipped the 60-minute chart. Let me see if there's anything there. Yeah, this was a pretty key support level. Broke down, we bounced, and we're above it now, so that's somewhat bullish. Trend indicators are still bearish. Again, I don't have any desire to mess with Microsoft right now. Amazon, this is an official trade idea. It's an official short on the site right now. Trend indicators remain bearish, although looks like we may be crossing over here. The MACD, that 9 EMA hasn't done so yet. But more importantly, from the chart, I mentioned this 723 is an important level. We're still above that. Still below that. We've already hit our first target on that trade, so it is a profitable trade. You can tighten stops, depends on your trading plan, do what you want. There's the daily uptrend line breakdown, tag of that first target level, and we've bounced. Long-standing divergence leading up to that high right here. And when we look at it from a weekly perspective, here's a stock with a very, very steep divergence on the PPO and the RSI with this most recent high. Amazon, God, I love the company. It's crazy how much I order from Amazon. I must probably at least twice a week drop orders in Amazon, multiple items. I'm a big Amazon fan. Amazon Prime, great business model. With that being said, the stock is just it's too richly valued, and if we are, especially if we are, on the precipice or in the early stages of a new bear market, these valuations are going to be corrected. This one has a lot of room to go on the downside. And this is just any bull market has marked, the highs with these excessive valuations, which clearly, I mean, whether you're a bull or a bear, I think it's hard for you to argue if you're bullish how excessive the valuations are right now or how lofty they are. Well, of course, everyone will rationalize it with the low interest rates and everything else, but that's dangerous. It's dangerous thinking, and it's the same thinking that occurs every time when a bull market's at top. It's different this time. That's what they say. So there's Amazon. You can see this trend line. This is the most recent uptrend line break that I showed you on the on the daily chart, and so far there's a stock that looks like it just broke down from a pretty bearish, clearly bearish technical pattern. Facebook, long-term uptrend line on the weekly chart here. We're dancing on it now. We've had a few intra-week breaks. You see we whip back up. That's why on a weekly chart you wait for a solid weekly close. There's also some support there. I've gone over Facebook before. This is what I expect to happen. I probably should have modified this line to look something like this. Move down to this level here, 89.69. A reaction there, and then a final move down to the 72.90 level. And if and when that happens, here, we'll move this line over. I think the timing of that will come in where this will probably become a primary. It is an uptrend line. You have at least 3 reactions right there, and you see how well that comes in with that horizontal support level. So I would put very good odds that anytime within the next year, probably within the next 6 months or so, maybe 6 to 9 months, that Facebook will be trading around $72.90, call it $73, and at the time it does, it'll come in, and I can even hold this line here and tell you roughly then. So that would be, call it around the end of October in this year, somewhere around there, time-wise. We'll see how that plays out. All right, I'm going to have to wrap it up here. I kind of expanded on a lot of stuff that I didn't really intend to in the beginning of the video, so we'll leave it at that. And if I see any other interesting developments on any of the top holdings, there's a few more that I wanted to cover before, but now this video's gone a little long. If I do see anything interesting on the top holdings, I'll go ahead and put that up in static post. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.